Hi, this is Chad. Welcome to the presentation, Saving Like the Wealthiest, Why and How to Create Your Own Private Vault Account. It's a European economic strategy that some Americans are already using to pay mortgages off sooner, finance vehicles, or fund business expenses in retirement. This is a high-yield savings account that gives you a loan while also paying you interest. They can be set to fit almost any individual household need, and they give you the ability to finance your expenses through them. We've done a 20-year comparison of a private vault savings account and a bank savings account. The private vault account outperforms the bank savings account, and it's not even close. So stick with me, but this is about to get really interesting. Where and how you save your money now at this exact moment in time will affect your future very, very directly. Why do we put money in a bank? It's not a trick question. Why do we put money in a bank? Most of us just put money in a bank because we're used to it. But really, we're just keeping it there until we decide what to spend it on. We think of a bank's main function is loaning us money, and keeping it there until we spend it is the best place for it. But really, a bank is just a middleman, because they use our deposits as liquid reserve collateral to go borrow credit lines from the federal bank, which they loan back out to borrowers, and then they keep a spread, in the same way a landlord has a mortgage but collects rent. Now let's look at some of the places people leave their money. Under their mattress. Well, cash is king. You do have easy access, but you don't have any security and you don't earn any interest. A checking account, you have easy access and it's transactional. A savings account, that's your security for a rainy day account, and you're earning a little, but probably not that much interest. There's an alternative to this, and that's what we're here to discuss today. 401ks and IRAs, high-powered savings accounts with some tax deferment that allows you to grow your savings until you pay the taxes later. And there's an alternative to this. Pensions, a payout for the future. Gold, and unless gold crashes, it is pretty secure, especially against inflation. Cryptocurrencies. They might be highly volatile, but they are easy to access. Stocks and bonds, potentially volatile, and there might be some hefty fees attached when you get ready to sell some of that so you can access the cash. Holding accounts, well, until you identify your next great investment, there's a much more beneficial account to keep your capital in so you can earn a little interest in the meantime. Real estate. A private vault account can create extra benefits if you're warehousing your money inside real estate. Many high net worth individuals are already using these strategies. Business assets, real estate, equipment. There's an alternative to add some extra value and security if you're doing this. And last, CDs and mutual funds. They have higher dividends, but you cannot access your money for a certain length of time. And there is an alternative, and we're about to get into it. So, what do you know about Austria? You know anything about Austria? Besides the fact it borders Germany and Arnold Schwarzenegger was born there? I didn't. Well, Austrians don't have the United States Social Security system to rely on when they get older, so they keep a portion of their savings inside their whole life insurance policies, and then they borrow against the cash value for their whole life. There is a very good possibility that the Terminator's grandmother had a cash value policy. I'll be back with my grandmother's cash value policy. I apologize for the bad Arnold Schwarzenegger impression. I couldn't resist. Well, here in America, the concept of using a whole life insurance policy as a savings account was created in the early 80s by a man named Nelson Nash, who was a student of Austrian Economics. Now, to understand Nelson Nash, you have to understand that there are two types of life insurance. The first kind, you get hit by a bus and your family gets $500,000. But then there's that mysterious kind that you hear stories about where someone sold their policy, but they didn't get hit by a bus and somehow still got the $500,000. And we've all seen commercials of this guy, J.G. Wentworth. It's my money and I need it now. Why would he run commercials to buy your structured settlement? Well, he's buying a predictable cash flow. And cash flow generation, whether it's a piece of real estate, an oil well, or a whole life insurance policy, is not going to have the same value at the beginning as it will decades and decades later. Drilling the hole for the oil well is always more costly than maintaining the pumps. Usually, the way to maximize a winning lottery ticket is through the cash flow. You can take the $477 million lump sum, $326 million after taxes, or you can get the big Powerball $768 million payout, $25.6 million a year over 30 years, and then borrow against it. After 18.6 years, the payout option surpasses the lump sum, and this guy missed out on 11.4 years of receiving $25.6 million a year. This is actually a hedge against inflation. If you Google, "Is cash king during inflation?" you will find, although inflation is low, you are losing purchasing power daily by holding cash. Cash is not king. Power, leverage, and control of the cash flow is. You cannot save your way into $1 million, especially if your money is not in an account giving you compounding interest with a high yield. In 1988, you could buy 4 stamps for $1. 30 years later, in 2018, you could only buy 2 stamps for $1. By now, most of us have seen this chart. You take a penny and you double it for 30 days. All of a sudden, after a month, you've got over $5.3 million. This is the compounding effect. After day 18, 19, 20, it starts doubling in the thousands, hundred thousands, all of a sudden millions. And while the whole life policies won't have this much compounding power, if you have a whole life policy, by the time the compounding starts kicking in, that's the time when you need it the most. If you're buying a term policy right now, you're just renting insurance. But what happens if you don't die? You don't get a refund. Something you might not have heard of is the Rule of 72. It has to do with compounding interest and how long it takes for you to double your money by earning it. If the length of time and the interest rate equals 72, that's how long it will take to double your money. For instance, 10% interest for 7.2 years equals 72. If you get 7.2% interest on your money for 10 years, you'll double your money. 5% for 14.4 years, 3% interest for 24 years. You can shake this up any way you like as long as it's 72. That's how you can double your money. Capital One will not pay you 5% compounded interest. But some of their cards can charge us up to, and maybe higher than, 25% compounded interest. And that's off credit lines they got borrowing against our savings. The real question should be, what's in your private vault account? A private vault account is basically a prepaid line of credit where you are the banker and you are the borrower. You can write checks off the account, and if you're a business owner, you should have at least 3 or 4 of these accounts. Ray Kroc ran McDonald's real estate holdings through these. Walt Disney ran the cash flow from the happiest place on earth through a life policy. And J.C. Penney ran portions of his business expenses out of the life policy. But don't worry, you don't have to be a titan of industry or super wealthy person to take advantage of these programs. If you're a small business owner and you're innovative, we can design one of these policies to help run all of your assets and capital through. If you're the head of a household, these are still great. If you lease equipment or vehicles, these are perfect. And they're great for employees' retirement accounts. If you were putting money into something each month that was eventually going to fail, when would you want to know? Probably as soon as possible, right? Well, a well-designed whole life policy is like having a crystal ball for picking a consistent place to warehouse and grow your money. The insurance factor eliminates the risk of loss. Now, this is an example of high risk. On May 15th, 1997, Amazon's IPO launched at $17 a share. If you would have bought $10,000 worth then, 23 years later, that 10,000 would be worth more than 12 million. Now, if you take a look at Amazon's stock price over the last 25 years or so, you notice that ever since the late 90s up until about 2010, kind of stays at about the same price. So just think you're putting money into that for over a decade, not really getting any returns, and then all of a sudden you hit stride. And around 2013, all that compounding takes effect and your exponential curve launches. Now, a whole life policy isn't going to have that much of an aggressive curve, but while we don't know what the value of a company is going to be in the next 25 years, where's the next Amazon, we know exactly how much the growth curve on a whole life policy will be. 60% of Americans do have some form of life insurance, with 24% of Americans having whole life insurance. Half of the people with the whole life policies are using them to help pay off their mortgages or supplement their retirement income. You can put as much or as little into the life policy or the savings aspect. You can put 50% into the savings and 50% into the life insurance. You can put 90% into the savings and 10% into the life insurance. But one thing's for sure, whole life policies are not a one-size-fits-all, and you really need a specialist that understands your unique individual need in order to have one set up properly. Right now, many more Americans are finally catching on about these cash value policy techniques. And when your time comes, it is easier to pass the wealth on to the next generation without probate or taxes. This basically becomes a pre-engineered trust. The death benefit pays out and your savings blossom. It transfers without probate or inheritance taxes. It transfers tax-free to your heirs because it allows them to be independent without reliance on government assistance. Again, why do we put money in a bank? When is the last time you've been to a bank branch? Banks are primarily transactional for the most of us these days. More and more millennials will eventually stop putting their money into savings accounts at banks over time. So is it more important to have a lifelong relationship with a bank or an insurance company? Well, to answer that, let's look at it from a 11-year-old Chad Mitchell perspective. We've got this strapping young lad with two really big front teeth. He's mowing yards in the hot Texas summer heat. He's making about $40 a week mowing 2 yards. $20 a yard? Come on, Dad. You could have done better than that. Well, I used to think it was really cool when I'd put $100 in my savings account and I'd earn $2 in a dividend. It was really cool as an 11-year-old to make 2% on my money. But as an adult, not so much. My mom actually opened my account for me because she was a teller at a bank at the time. And back then, the fees were not even close to what they are today. That's why we shut the account down. Today, a bank will fee you to death. They've got monthly fees without high balances. If you don't keep a minimum balance, they're going to charge you. If you take a bank loan from them, they're going to charge you a real high interest rate and not pay you a compound interest. Fees after passing withdrawal limits, restrictions on withdrawal methods. Many banks pay less than 1% a year in interest dividends on money left in their savings accounts, even though they borrow against it and sometimes earn double-digit returns. We pulled the pricing for savings accounts off of big bank's website, and they're paying 0.03% interest to their account holders, but they're charging them a $8 monthly service fee unless they keep a $500 minimum balance. And if you withdraw more than 6 times a month out of this account, you pay $10 per withdrawal. And since inflation is usually over 2% each year, the value of your dollar continues to shrink, leaving it in a bank's savings account. You just don't really get the benefit of leaving your money in a savings account anymore. So why do we keep leaving all of our money in a bank? A bank is not our friend. We're just used to it, and we don't know other alternatives exist. This is basically a lifelong account you can live your entire life out of. You don't have to put your entire life savings into one to start, and you can have multiple accounts also. While we can't go back to when we were 11 years old and start one for ourselves, we can start one for someone younger as a small college fund or general life expense account, and I'm pretty sure they'll thank you later. Family expenses, property taxes, instead of paying impounds each month, perhaps you pay it through your life policy. Why give the government a free loan, right? It's just a lifelong piggy bank with more benefits than a savings account at a bank could ever match. The private vault account outperforms the bank savings account, and it's not even close. There really are so many things that you can do inside these policies. You can finance vehicles, real estate, property taxes on the real estate, start a college fund, finance your business inventory and procurement needs, or the assets and the business equipment. All of this stuff can be done through the policies. And that's it. That's the presentation. Saving like the wealthiest. What we need to do now is find out what your short and long-term savings can look like inside a private vault account. Let's schedule a time.